Welcome to the deep dive. Today, we're tackling something pretty huge. The hidden structures, the architecture of global power. We've got this mountain of source material that goes way beyond just headlines. It maps out the financial, the tech, the political blueprints that really decide who gets rich and how fast.
It really is a study in concentration,
What
isn't
then?
it? What the sources show is that the world isn't just, getting wealthier overall. It's being fundamentally reorganized.
Hmm.
Economic power, technology, strategic influence, it's all being channeled into fewer and fewer hands. So our mission today is to cut through the noise. Right.
Yeah, find the pattern.
Exactly. Distill those core mechanisms that are actually driving this incredible concentration of wealth and, well, power.
And I think we have to start right at the beginning, at the foundation. You can't really talk about 21st century wealth concentration, plutocracy, without getting the theory straight first.
Absolutely.
It's not just about spotting billionaires, it's understanding the engine that creates them. We need those core economic concepts that explain today's inequality.
Precisely. And if you want to understand why the share of national income coming from capital, from wealth itself, is climbing so much, especially in mature economies, you have to look at Thomas Piketty.
Okay.
He gives us these two equations, which look simple on the surface, but they really unlock the whole historical and current picture of wealth concentration. But maybe before the math, the history.
Yes, let's do that. Let's unpack the history first.
Yeah.
What did this capital accumulation actually look like, say, in Britain or France before the massive disruptions of the 20th century?
Right. So if you track what's called the national capital to income ratio, basically, the total stock of wealth measured in years of national income, it was incredibly high and stable for almost 2 centuries.
Wow.
Yeah, through the 1700s and 1800s in places like Britain and France. This ratio usually sat somewhere between 6 and 7 years of national income.
6 to 7 years. Think about that.
It means the value of all the accumulated capital, land, buildings, businesses, everything was worth 6 or 7 times everything the country produced in a year. That massive weight of capital really defined the Gilded Age in the 19th century.
It's just a staggering amount of embedded historical wealth. And then the 20th century happened. The shocks must have been brutal for capital holders.
Oh, catastrophic. You had 2 world wars, the Great Depression, then periods of high inflation, often very high taxes on capital and inheritance. It caused that ratio to just collapse.
How low did it go?
By the mid-1950s, the national capital in these countries was down to maybe 2 to 3 years of national income. It was this massive, almost unprecedented societal redistribution, though, a violent and chaotic one.
A near total reset of that old structure. But the sources are clear. The return journey, the rebuild, has been pretty relentless since then.
Absolutely relentless.
Yeah.
From the 1950s onwards, that rebuilding started. Slowly at first, but just inexorably. By 2010, the total value of national capital in both Britain and France was right back up to around 5 to 6 years worth of national income.
So we've basically spent the last, 60, 70 years quietly rebuilding the pre-war capital structure.
Pretty much. And this huge rebound, Piketty argues, is fundamentally explained by those 2 core equations he lays out.
Okay, let's take a moment for these because they really do feel like the physics of this whole process. The first one, it connects the share of income going to capital with the return on capital.
Right, that's alpha times beta.
So alpha is capital's share of national income. It equals R, the rate of return on capital, multiplied by beta, which is that capital income ratio we just talked about.
So high return on capital, large stock of capital relative to income.
Means capital gets a bigger slice of the pie. Simple as that. Seems straightforward. But it's that second equation, the one explaining why beta, the capital income ratio itself, gets so high that feels like the really critical piece for today.
Yes, exactly. That's the long-run driver. The second equation is beta is SGGI. It says that in the long run, the capital income ratio is determined by the savings rate divided by the economic growth rate, beta.
Feel it's SGM, okay.
Okay.
And this is the mechanism that, it almost mathematically mandates wealth concentration in mature, slow-growing economies.
Okay, unpack that a bit more. Why does dividing savings by growth inevitably lead to more concentration?
Yeah.
It feels like the core insight here.
It's about how those variables behave over time. In mature economies, think the US, UK, France, Germany, Japan, the overall economic growth rate, tends to slow down. It might settle around, say, 1%, maybe 1.5% per year in the long run.
Right. Lower growth becomes the norm.
But people and corporations still tend to save a fairly stable portion of their income.
Yeah.
So what happens when you divide a relatively stable savings rate S by a smaller and smaller growth rate G? The result, beta, has to get bigger.
It has to explode mathematically. If growth halves, the amount of capital needed to absorb those ongoing savings effectively doubles relative to income. Wealth starts piling up much faster than the economy's growing. So this structural reality makes capital concentration, well, almost a built-in feature of slow-growth modern capitalism. It's not some kind of bug or policy failure, necessarily.
So that historical trend and the math explain the pileup of capital. But who's actually benefiting most today? The sources really emphasize a key modern shift, this rise of the supermanagers, especially in the U.S.
Yeah, this is where the story takes a fascinating turn because it's not just about old money, inherited wealth anymore. That really sharp increase in very high incomes we've seen since the 1980s, particularly in the U.S., it's largely driven by the, well, spectacular compensation packages of these supermanagers.
And these are top executives at big companies.
Exactly. Top executives whose pay, often loaded with stock options, bonuses, is technically labor income. They're being paid for their work. But the amounts are so huge, they operate on a scale that used to be reserved only for returns on large amounts of capital.
So it's labor income, but it functions almost like capital income in terms of its sheer size and impact.
Precisely. But here's the interesting paradox the sources point out.
Yeah.
You can't just look at the 5 or 10 highest paid CEOs whose names are always in the news and say, okay, that explains it.
Right, there aren't enough of them to account for the scale of the shift at the top.
Exactly. If you just count those few dozen executives whose pay has to be publicly disclosed, it doesn't add up to the massive increase in income reported in the top 1% or 0.1% of U.S. tax returns over recent decades. The story isn't just those few titans at the very peak, it's the much broader managerial class just below them.
So the real action is the breadth of this high-earning managerial aristocracy.
Absolutely. The sources suggest that in many large U.S. firms, you've got dozens, maybe even hundreds, of executives, senior VPs, top lawyers, investment bankers whose total compensation puts them squarely in the top 1%.
Which was what, around $352,000 back in 2010?
Yeah, around that. And many are well into the top 0.1%, which meant incomes over $1.5 million then. It's this whole deep managerial caste that has managed to capture a really significant share of corporate profits. And this fits perfectly with that, that famous Citigroup analysis that described the U.S. as a plutonomy, an economy basically powered by and geared towards the spending and needs of the extremely wealthy.
Okay, so if the supermanagers dominate that top 1% or 0.1% with their labor income, how does the source of income change as you climb even higher? Right to the very, very top of the pyramid.
Yeah, the mix changes dramatically. If you look across that whole top decile from the 90th percentile right up to the 99.99th, you see labor income becoming less and less important the higher you go.
So the supermanager effect fades out at the absolute peak.
It does. They dominate the top 1% and 0.1% bands, like we said. But once you hit the top 0.01% or the truly stratosphere levels, income is overwhelmingly from capital. Dividends, capital gains, investment returns. It shifts from rewards for elite labor back to returns on pre-existing capital.
This incredible concentration of wealth within countries like the U.S., it stands in pretty stark contrast to the persistent reality of global labor inequality, which brings us to that astonishing wage gap you mentioned.
Yeah, the historical comparison here really slams it home. The economic historian Branko Milanovic, he looked at global wage gaps back in the 19th century. He found that an unskilled daily laborer in India between 1800 and 1849 earned roughly 30% of what a similar worker earned in England.
30%, that's a big gap for sure.
A very significant gap, absolutely. But it's almost nothing compared to the chasm we see today.
You called the 19th century gap trivial compared to now, so just how wide is the modern divide?
It's orders of magnitude wider. There's this 2009 data from UBS on global prices and earnings. Let's take a building laborer. The nominal after-tax wage for that worker in New York City was $16.60 an hour.
Okay. $16.60.
Now compare that to the same kind of laborer in Beijing, so around 80 cents an hour, or Delhi, total 50 cents an hour, Nairobi, 60 cents.
60 cents. Compared to over $16.
Yeah. We're not talking about 30% anymore. We're talking about maybe 3 or 4%. It's a 30-fold difference, roughly, for the same basic labor input.
So global labor is far, far more unequal today than it was even at the height of industrial revolution and colonialism. That's counterintuitive.
It really is. What happened is the Industrial Revolution didn't just enrich the factory owners in the West. It also created this massive, relatively well-off middle and working class whose earnings just soared far, far beyond their counterparts in the developing world. And while globalization has maybe started to close that gap a bit in some skilled areas, that fundamental unskilled labor gap, it remains immense. And of course, it fuels the constant search for cheaper labor globally and allows multinational corporations to capture huge benefits from these wage differences.
Okay, so we have these structural forces, capital accumulation, the supermanager class, vast global wage gaps. And now technology is pouring gasoline on the fire, right? Reshaping everything.
Right.
And the most critical new battleground for concentrated power seems to be artificial intelligence, framed often as this zero-sum game, mainly between the US and China.
Yeah, that geopolitical AI race is central. And a useful way to understand it, according to one of our key sources, Kai-Fu Lee, is through these four distinct waves of AI development.
Four waves. Okay.
Each wave uses different kinds of data, needs different resources, and gives different types of power. You have internet AI, then perception AI, then autonomous AI, and finally, business AI.
All right, let's break this down. What's the current score? Who's leading in which wave and why?
Well, China's in a very strong position overall, mainly because of its absolutely enormous unified pools of data and, frankly, strong government support. So they're really well placed to lead, or at least co-lead, in internet AI, I think search algorithms, social media optimization, recommendation engines, and also perception AI.
Perception AI, that's things like facial recognition.
Exactly. Facial recognition, object recognition, analyzing real-world images and video. Areas where just having more data gives you a huge advantage.
Right.
China's got that data scale. They're also expected to catch up pretty quickly in autonomous AI, self-driving cars, drones, robotics.
Okay, so China's strong in 3 out of 4. Where does the U.S. still hold a clear lead?
Business AI. That's really the one area where the U.S. currently has a distinct, undisputed edge.
Business AI, applying AI to internal company stuff, supply chains, decision-making.
Right. Using AI for complex enterprise resource planning, optimizing logistics, internal workflows, drug discovery, financial modeling, it requires navigating really complex, often messy, siloed corporate data. Plus deep industry-specific knowledge. Silicon Valley firms with their long history in enterprise software, SaaS, cloud computing, they just have a head start there.
But what about autonomous AI? You said China is expected to catch up, but our sources mentioned a persistent gap there, specifically with self-driving cars.
That's right. It's actually quite revealing. Even with massive investment, American companies are still seen as being maybe 2 to 3 years ahead of Chinese competitors in fully autonomous driving.
And in AI development, 2 or 3 years is practically an eternity. What's causing that specific gap if it's not just data or money?
It really seems to boil down to the critical need for elite, truly world-class engineers and researchers. Autonomous vehicles, especially self-driving cars, are incredibly complex.
Yeah.
You have to solve for these bizarre edge cases, the 1 in a million situation that could be fatal.
Like the source mentioning a child running out juggling flaming bowling pins.
Exactly. Maybe not that specific, but you get the idea. Solving these safety and complexity problems relies heavily on very advanced techniques like reinforcement learning, massive simulations, and that takes this tiny, globally elite group of AI minds. The fact that U.S. firms, especially companies like Google, Waymo, can still attract and retain the very, very best of this global talent pool seems to be the single biggest reason that autonomous AI gap still exists.
The sheer potential of this technology, AI and automation, to just wipe out huge numbers of jobs. It's led some of the tech elite themselves to start advocating for universal basic income, UBI. Our sources call it their magic wand.
Yeah, it's a really interesting kind of ironic twist, isn't it? The very people creating the disruption are proposing the safety net, and the motivations seem pretty dual.
Okay, what are the two sides?
Well, on one hand, you have to assume there's some genuine ethical concern there. Concerned about the massive social upheaval if AI really does eliminate millions of jobs in trucking, logistics, customer service, and so on.
Okay, so the altruistic motive, but then there's the self-interested angle, which feels maybe more compelling.
I think you have to consider it, yeah. It's described as a fear, essentially. These tech entrepreneurs, they've made billions, often by disrupting established industries and workforces. They are acutely aware, it seems, that if mass unemployment hits and society gets destabilized, they become the very obvious, very visible targets for, mob anger, as one source puts it.
So UBI is like social insurance for the disruptors.
Kind of, yeah. It's framed as a way to potentially pacify a displaced population, maintain social stability, and ultimately safeguard their own fortunes and status. pay a premium through taxes for UBI to prevent the whole system from collapsing in anger.
Fascinating. Okay, let's shift from the sort of heavy industry of AI to the platforms themselves. We see digital dominance reshaping not just economies, but human interaction, even self-worth. Instagram feels like a prime example of how a simple app creates a whole new economy of influence.
Oh, absolutely. Instagram's evolution is really telling. It started out pretty simple, right? Photo sharing, but the hook was the filters. They made mediocre early smartphone photos look kind of cool, stylized.
Right, it enhanced reality.
Yeah, it was about enhanced images, maybe a creative outlet, but it morphed very quickly. It went from being a fun hobby space to being this essential tool for crafting, managing, and ultimately capitalizing on a public persona.
It basically professionalized the presentation of personal life.
Totally. It became the birthplace of this economy of influence.
Yeah.
Your value, your potential income became tied to how perfect, how aspirational, how reachable your curated digital life looked. But that relentless pressure to perform, to demonstrate this perfect life, it created real problems. The data showed it was becoming psychologically damaging for a lot of users. Constant comparison, anxiety, feeling inadequate.
And that psychological toll actually created an opening for a competitor, didn't it?
It did. That intense pressure cooker environment on Instagram was apparently great news for Snapchat. Snapchat took off partly because it offered the opposite, ephemerality. Photos and videos that disappeared, less pressure, more spontaneity, more imperfection allowed. It was the psychological release valve that Instagram's curated permanence had kind of extinguished. Shows how even dominant platforms can create their own vulnerabilities.
Right. Okay, so if tech is the new influence sphere, high-speed finance is still maybe the fastest way to generate staggering wealth, almost instantly. And nothing really embodies that speed, that velocity like high-frequency trading, HFT.
Yeah, HFT is the ultimate example of wealth concentration driven by, like, literal physics. It proves that in today's markets, physical distance, light speed translates directly into profit. You have firms spending fortunes, laying their own fiber optic cables, building microwave towers just to shave millionths of a second off the time it takes their orders to reach the exchange servers.
Microseconds. We're talking, what, 465 microseconds in one example. Why is that infinitesimal slice of time so valuable?
It's all about latency arbitrage, exploiting tiny, fleeting price differences between different exchanges, or even just predicting the next tiny price move milliseconds before anyone else. To capture that fleeting opportunity, your electronic order has to arrive at all the relevant exchanges almost simultaneously within that microscopic window. If you're even a fraction of a second too slow, the opportunity is gone. Someone faster got there first.
So you can't rely on public internet infrastructure. You need your own private racetrack.
Exactly. You have to own the infrastructure.
Mm-hmm.
And this tech arms race has created this really peculiar market inefficiency. It's not making markets better. It's allowing a small group to systematically exploit everyone else.
Yeah, one source compared it to finding a broken slot machine in the casino that pays off every time. How does that exploit actually work? What's the mechanism?
It's really about exploiting the market's plumbing, the microstructure. Public exchanges, trying to attract trading volume, introduce all these complex order types and speed advantages that HFT firms became masters at using. They don't make money by predicting long-term value. They make money by predicting the immediate intent of other traders, especially large institutional traders.
So they see a big buyer coming.
Right. They see the first few small feeler orders with the big pension fund trying to buy a large block of stock without moving the price too much. The HFT algorithms instantly recognize the pattern, anticipate the larger order coming behind it, jump in front, buy the stock, and sell it back to the institution moments later at a tiny, fractionally higher price.
It's just skimming. Pure skimming.
Pure electronic front running, yeah. Skimming pennies or fractions of pennies, but doing it millions, maybe billions of times a day across thousands of stocks.
And what's really wild is how the big Wall Street banks, the ones supposedly acting for those pension funds and other investors, actually end up helping the HFT firms do this.
It's a massive conflict of interest, or at least a perverse outcome. A big bank needs to buy, say, 100,000 shares of IBM for a client. They usually don't just send one giant order because that would move the market against them.
Right, so they break it up.
They break it up. They ping away with lots of tiny 100-share orders, maybe over several minutes or hours. It's called order splitting, meant to hide their size. But for the HFT algorithms,
It's a loud signal, insistent, noisy demand, as the source puts it.
precisely. The HFT systems see this stream of small orders from the same source, know what big fish is buying, and they just start nudging the price up slightly ahead of each incoming small order. So the bank's client, the actual investor, ends up paying a higher average price for the stock than they should have. The HFT firm pockets the difference. Yeah. The investor pays the bank for expert execution, and the bank's execution method basically feeds the predator. It's wild.
Moving from those microsecond battles to broader corporate control, the 1980s, you had the leveraged buyout, the LBO era, the barbarians at the gate, like KKR taking over RJR Nabisco. That was about external pressure, right? Buying companies, loading them with debt, slashing costs.
Yeah, that was the classic model of external extraction. Buy it, strip it, flip it. But the sources make a really important point by highlighting figures like Jack Welch at General Electric during roughly the same period.
Okay, Welch. Neutron Jack.
Exactly. While the private equity guys were doing this from the outside, Welch was pioneering a similar kind of ruthlessness, the same focus on short-term financial metrics over everything else, but from inside a major corporation.
How did he manage that? Driving that kind of internal, almost PE-style pressure while GE still looked like this stable giant?
Well, he was relentless. He instituted the rank and yank system, firing the bottom 10% of managers every single year, created this constant state of fear and internal competition. But crucially, he shifted GE's focus dramatically towards GE Capital, the financial arm. It became the engine, not the traditional industrial businesses like jet engines or turbines.
And GE Capital became a tool for smoothing earnings, right? Meeting Wall Street's demands quarter after quarter.
It was absolutely essential for that. GE Capital's huge, diverse portfolio lending, leasing, insurance allowed Welch incredible flexibility. He could use, let's say, creative accounting or just sell off pieces of the portfolio to ensure GE always hit those precise quarterly earnings targets that Wall Street obsessed over. If manufacturing was having a tough quarter, GE Capital could magically make up the difference. This relentless focus on the short-term stock price achieved through internal cost-cutting that mirrored the LBOs and financial engineering. It lacked, as one source puts it, any real commitment to people or product in the long run.
Okay, let's shift geography now to Southeast Asia. A different model of tycoon building, often less about pure market mechanics and more about, well, proximity to power, navigating gray areas, maybe operating outside the formal rules sometimes. The world of the Asian godfathers.
Yeah, this is often a story rooted in post-colonial chaos and opportunity. Wealth built on mastering logistics, securing political patronage, and sometimes exploiting loopholes or engaging in outright illicit trade. Take Singapore right after World War II. It was this key logistical hub that meant huge opportunities for smuggling.
Smuggling what?
Things like vital goods, smuggling rice into nearby Malaya, which was starving, or smuggling industrial commodities out of Indonesia, which was newly independent and chaotic. These weren't small-time operations. They generated foundational fortunes for some families.
And there's that amazing anecdote that really underscores how embedded this became, even socially accepted to a degree.
It's incredible, yeah. The story goes that the big obelisk built in Singapore to commemorate the Chinese civilians killed by the Japanese during the occupation. It was apparently mostly paid for by smugglers.
Wow. Using illicit profits to fund a major public war memorial.
It shows how wealth generated outside the formal system could be laundered, in a sense, into social legitimacy and public status.
And the ultimate example of mastering this complex environment is often seen as Li Ka-shing in Hong Kong. He's presented as the archetypal self-made man, rags to riches.
That humble origins myth is incredibly powerful and carefully cultivated. And he certainly started small, in plastics, then moved into real estate very successfully. But his truly transformative leap, the one that vaulted him into the absolute top tier, came in the late 1970s. The colonial-era powerhouse, Hong Kong Bank, now HSBC, essentially handed him control of Hutchison Whampoa, one of the old British trading conglomerates.
Handed him? How?
They sold him their controlling stake untendered. No public auction, no competitive bidding. It was a behind-the-scenes deal, a massive transfer of corporate power facilitated by the dominant colonial bank to a chosen local successor. That instantly made him a major player.
And once he had that massive platform, Hutchison Whampoa, he proved brilliant at navigating financial cycles, too.
Oh, impeccable timing. His most legendary deal was probably selling the Orange mobile phone network. He built it up within Hutchison, then sold it near the absolute peak of the 1999-2000 tech bubble to Mannesmann in Germany. The profit was reportedly around US $15 billion. Yeah, just astronomical. He's a financial wizard, no doubt, but also someone who benefited immensely from that initial preferential treatment and maintains this image, famously taking only a nominal salary while collecting billions in dividends, largely untaxed under Hong Kong law.
Before we move off Asia, there's a crucial point about systemic risk for ordinary people caught in these systems.
Yes, this connects back to inequality. Many Southeast Asian countries have mandatory provident funds, forced savings schemes. Ordinary workers have to put a chunk of their salary into designated investment funds.
Well, forced saving sounds potentially good.
Potentially. But the issue is, these funds often invest heavily in the regional stock markets, which are frequently dominated by the conglomerates controlled by these same tycoons or families. And historically, the long-term returns in many of these markets have been, well, pretty poor compared to global benchmarks. So you have ordinary people legally required to funnel their life savings into markets that often deliver mediocre returns, arguably benefiting the insiders more than the savers themselves. Unless that trend changes, it locks in a certain kind of structural inequality.
This accumulation of power, whether through finance, tech, or political connections, it often involves pushing boundaries, sometimes crossing ethical lines. And few examples are as stark, as devastating as Purdue Pharma and its role in the opioid crisis.
Yeah, the sources describe a story that starts with, perhaps, genuine scientific interest mixed with intense commercial ambition. Back in 1991, Richard Sackler was apparently very excited by early findings suggesting high-dose oxycodone could be a good alternative to morphine for severe cancer pain, supposedly with no unexpected side effects.
But the focus didn't stay on cancer patients for long.
No. The crucial shift was aggressively marketing OxyContin not just for severe end-of-life pain, but for all sorts of chronic, non-cancer pain, back pain, arthritis. A vastly larger market. And they coupled this with a massive, misleading marketing campaign downplaying the addiction risks.
And internally, there was this huge conflict over the drug's known potential for abuse, right?
Yeah.
They resisted admitting the problem.
That resistance seems key. For years, there was internal debate about developing an abuse deterrent formulation, a pill harder to crush or dissolve for snorting or injection. But the Sackler family, particularly Richard, reportedly resisted this. The thinking, according to insiders, was that introducing an abuse deterrent version would be seen as an admission that the original formula was dangerously abusable, validating all their critics. It was about never conceding error.
They eventually did reformulate it in 2010, but the outcome was tragically counterproductive, wasn't it?
Horrifically so. The 2010 reformulation, the abuse deterrent version, actually worked quite well at reducing OxyContin abuse specifically. People couldn't easily tamper with it anymore. But here's the devastating unintended consequence confirmed by economists later. The reformulation actually increased overall overdose rates.
How? By shifting demand.
Exactly. Purdue had spent over a decade creating this huge population of people dependent on high doses of potent opioids. When the easily abusable OxyContin supply dried up overnight, the underlying addiction, the demand, didn't just vanish. It migrated. People switched to whatever else was available in potent, primarily heroin, and then increasingly illicitly manufactured fentanyl, which was even cheaper and deadlier. Purdue choked off the supply of their pill, but effectively supercharged the black market.
That kind of ethical corner-cutting or denial, it's often protected by layers of influence. Which brings us to the legal maneuvering, the paranoia of powerful entities.
Yes, when facing serious legal threats, companies like Purdue deployed the revolving door strategy with devastating effect. They'd hire former high-ranking government officials. The example given is retaining Howard Shapiro, who had been general counsel at the FBI. The tactic was clear. If local U.S. attorneys, say in Virginia, were building a strong criminal case based on the evidence,
The high-powered D.C. lawyers could go over their heads.
precisely, use their connections, their access gained from previous public service to lobby political appointees higher up at the Department of Justice in Washington and try to get the case killed or settled on very favorable, often lenient terms. It's using the structure of power itself as a shield against accountability.
This idea of using institutional power to bypass obstacles,
Yeah.
it's not just in pharma or finance. We see a similar dynamic, maybe less overtly malign, but still profound, in something like urban planning history.
Robert Moses is the absolute archetype here, the master builder of New York City. But his influence went far beyond New York. He was instrumental in teaching the whole philosophy and methodology of the interstate highway system to engineers across the country.
He taught them how to build the highways.
He taught them how to ram massive expressways through dense cities, which often meant destroying neighborhoods, displacing thousands of people, mostly poor and minority residents. Highway engineers from dozens of states came to study his methods in New York.
And what was the core lesson? What was his greatest secret they came to learn?
According to the source, Robert Caro's definitive biography, His greatest secret, the key technique studied by engineers nationwide, was simply how to remove people from the expressway's paths.
Wow. Not engineering, but people removal.
It was a mastery of condemnation law, manipulating public hearings, controlling the press, leveraging political power, everything needed to neutralize opposition and forcibly clear the land for his concrete vision. And the ultimate irony, which just captures the sheer detachment that kind of power allows. Moses, the man who arguably shaped American car culture and commuting more than anyone, he never drove a car himself, except for a few lessons in 1926 that he quickly gave up on.
Never drove. That's incredible. Okay, let's bring back to the present day, to the personality type that seems to thrive in this high-stakes environment. The unpredictable, disruptive industrialist. Elon Musk comes up as a key example.
Yes, Musk seems to embody this blend of, visionary genius and operational chaos. People working for him talk about his devotion to reality-defying schedules. Apparently, he'll commit huge amounts of capital, ordering vast quantities of materials way ahead of time, even when it seems impossible they'll actually be needed or used that quickly. It puts immense strain on cash flow, but he insists on the hyper-aggressive timeline, trying to force the impossible.
And this industrial intensity is matched by some pretty interesting personal eccentricities, suggesting maybe the internal pressures are immense.
Absolutely. There's the detail about him being, despite his wealth, the world's wealthiest couch surfer. When he visits Silicon Valley, crashing at friends' places, instead of having his own permanent, lavish base there. And perhaps more revealingly, his brother mentioned Musk's interest in trying an ayahuasca ceremony. The hope, apparently, was that it might induce an ego-death experience that could help him tame his demons.
Trying to tame the demons that drive the ambition.
Perhaps. It suggests an awareness, maybe, of the immense psychological toll that comes with operating at that level of relentless, world-altering pressure and ambition.
Okay, so wrapping this up, we've traced this deep dive through the mechanisms concentrating global power. We've seen the financial architecture, Piketty's capital accumulation returning to historic highs, driven by that CGL dynamic in slow-growth economies.
We've seen the rise of the supermanager class capturing huge chunks of income, especially in the U.S. We've looked at the AI race between the U.S. and China, shaped by data access and that critical need for elite engineering talent. And the sheer velocity of HFT basically institutionalized skimming in financial markets.
And a recurring theme seems to be that success at the very highest levels often involves more than just merit or innovation. It relies on influence, timing, sometimes bending or breaking rules.
Yeah, whether it's Li Ka-shing getting that untendered deal for Hutchison Whampoa, or the big banks enabling HFT profits through their trading patterns, or Robert Moses steamrolling communities, or Purdue Pharma navigating the legal system. It seems extreme success often involves leveraging structural advantages, political connections, or just operating right at the edge of, or sometimes well beyond accepted norms.
And the ethical compromises can be enormous, leading to real societal damage, like the opioid crisis being inadvertently worsened by the very attempt to make OxyContin safer, pushing demand onto the streets.
Which brings us to maybe a final provocative thought to leave listeners with. We talked about the Asian godfathers, how many built fortunes by defying rules, benefiting from patronage, yet often projecting this humble origins myth. In today's world, with finance moving at light speed and technology having global reach instantly, are the pressures now so intense? Are the structures so geared towards rewarding scale and velocity above all else that maybe only those willing to embrace that kind of chaos, to push ethical boundaries, or those who already have significant inherited or political advantages? Are they the only ones who can truly reach and hold on to that level of global mastery today?
That question of structural advantage versus rule bending and the ethical cost, that really feels like the core tension in the architecture of power we've explored today. Thank you for joining us for the deep dive.